episode, we'll explore venture debt, the true cost to your business, and how it compares with AR financing. For founders looking to fund growth in their mobile app and gaming companies, venture debt can seem like an attractive, non-dilutive alternative to equity when it comes to funding UA spend. Venture debt is often introduced at a time of a venture capital round or soon thereafter, and also sometimes as a way of extending cash runway between venture capital rounds, giving the company time to execute further milestones before fundraising. Repayment periods can be anything up to 5 years, but 2 to 3 is the norm. Venture debt is normally structured as a term loan, which means that you receive all the money up front and then have to pay down the loan over the term in regular agreed installments, including both the principal and interest payments, just like a personal loan or a small business term loan. Often you will have to pay additional setup and legal fees depending on the complexity of your business and the level of due diligence required. Venture debt lenders will also typically require warrants in the company, around 0.25 to 2%, to give them additional upside if the company is sold or listed. Some venture-backed companies consider venture debt as a way of funding their UA, but having spoken to multiple founders and CFOs, this does not always work out as expected due to the inherent unpredictability of the UA landscape and a mismatch in cash flow and timeframes. For example, if you raise a $2 million venture debt investment, it is impossible for you to spend it in one go. It will be spent over a matter of weeks and more likely months in order not to send your short-term UA costs sky high. It is important to look at the revenue profile where you're actually earning cash through monetization of the app or game, when you get paid by the platforms and when you have to pay interest on the loan. As a capital-efficient CFO, you are trying to match your investment horizons. Venture debt can be a great source of additional, lower-cost capital than raising equity and can be used to a great effect in a number of scenarios. For example, if you are looking to acquire a new game or title from another publisher with a predictable cash flow that can be serviced and paid down over time, and you need to fund the acquisition up front, then venture debt could be an extremely efficient way to do that. Alternatively, you may be looking to fund the development of a new game or a new app, and you already have existing cash flows from your business to service the debt. Using venture debt to invest in creating a new intellectual property and using existing cash flows to pay the interest is a smarter alternative to raising additional equity for a company concerned with capital efficiency. AR financing is a very flexible source of capital that is secured against accounts receivable revenue from the app stores and ad networks. It is an elastic form of credit that you can easily dial up or dial down as quickly as you need it. Because of that inherent flexibility, it's a very efficient way of funding user acquisition campaigns. If the UA trade is working, then AR lines can be drawn down on and maxed out as quickly as the accruing sales permit. And as the UA opportunities wane, CFOs can dial back on the amount drawn on their AR facility to be in line with the level of cash requirement. AR lines are typically much more scalable than venture debt. For example, if your AR is growing rapidly and the facility is working well, lenders will have much more flexibility to increase line limits than going through a new diligence process to restructure or replace existing venture debt facilities. AR financing also limits cash drag, lazy cash sitting on a balance sheet on which the company is paying interest, and enables a much closer matching of the funding needs for the user acquisition. In summary, there are pros and cons to any form of financing, venture debt, AR financing, venture capital, etc. Founders and CFOs should always research and model all the options and seek the form of capital that best matches their needs.